Everybody, and welcome to the Markets Overview January 2020 edition. For those of you that are tuning in and are existing clients of mine, you should know me pretty well, or we should know each other pretty well. For those of you tuning in just for some market overview info, welcome. My name is Goran Ognjenovic. I am the founder and the Chief Investment Advisor for the Independent Investment Advisors. We're a boutique wealth management practice located in Portland, Oregon. I've got my contact info up on the screen. If you have any questions or like to work with us, please feel free to reach out. Before I dive into the market insights here, I need to put up a standard disclaimer. So anything I say is really to be used as educational tool, should not be construed to be investment advice. Investment advice needs to be tailored to a particular investor and their specific needs. If that's you, please reach out to me and we can have a conversation and we can come up with an investment plan for you. Also, there's a high degree of risk in investing and trading. We assume no responsibility, and we may or may not hold positions in some of the instruments and securities that we're going to talk about today. So I'll give you guys another minute to read through this, and then we will go to the agenda. All right. So general principles. This is sort of how we like to think about, or really how I like to think about the markets and portfolio management, as well as timing of things. We are always invested. Our clients, for the most part, are always invested. This primarily really refers to clients that or portfolios that are equity based, right? If you're close to your retirement, you are likely fully invested, but mostly in income, not so much in equity. So, maybe not so much. But if you're if you're further away from retirement or from your investment goals in general, we like to keep our clients fully invested, and then we like to adjust the ratios, right, of asset allocations based on what's going on in the market conditions, right? One of the major advantage for us is we don't manage $1 billion, so if market conditions change, we can reposition our clients and their portfolios really in a matter of a couple of days. We don't have to it's not a month or 2 month or 3 month long process, right, to reallocate all the capital. We don't have to file market impact reports with SEC or anything like that, right? So that's a real advantage of being relatively small and boutiquey. And along those lines, because of that, we're able to really follow the market a little bit more as opposed to anticipate, right? So our primary analysis is really based on charts, chart analysis, or really sort of a price behavior. So we can watch for clues of institutional activity, and then marry that up with other things, and then make decisions based on that. So that's not to say that we ignore economic indicators or fundamental analysis of the companies or things like that, right? All that's really accounted for. But our primary driver is the reaction of how market reacts to to any of those news or reports that come out. So with that said, I'm just gonna kind of dive into this. So this video is primarily focused on equities, and we like to be a little bit more weight on U.S. side of things. I will cover income just a bit in this video, and then I will create another video that will talk about where to find income and how to handle income in these in this current environment. So what we're looking at here is S&P 500. For those of you that are new, S&P 500 is an index. It represents 500 of the largest companies in United States, right? So as you would expect, your Apples, your Boeings, your Microsofts, your Amazons, Home Depots, all your banks, sort of largest companies. They tend to be global, right? So there's quite a bit of sort of global exposure to their business. So it's for all intents and purposes the market, right? When you hear people talk about the market, S&P 500 is really the best gauge of what the market's doing. It used to be Dow, but it's got substantially. It's only 30 stocks, and it's not really a good proxy for the entire market. So a couple of things with this. A lot of conversation on. So what we're looking at here is May of 2018, roughly, all the way through January of 2020, and a couple of things I want to talk about in this chart. And there's a reason I sort of extended this chart for 18 months or so. Lots of conversation in the news where we are in the cycle. Are we in a bull market? Are we in a bear market? What's going on? I wanted to highlight this little these couple months right here. So that was October, November, December of 2018, right? So this correction here from this 2900 level, 2930 down to really 2346 was around 20%, right? And it took sort of 3 months for it to develop. So to me, that's the correction, right? That was the bear market. We had a 3 months of a bear market. We had a 20% correction. We cleared out. I love to see this sort of level here that got broken. This level at 2631, right? It came down. The prices came down. The valuations, I guess, came down to that level, right? Bounced off, then came down again, then bounced off, then came down again, and then broke it. And then made another leg down, and then launched from that point on. So to me, that was the bear market, right? That was the bear market we had, and I'm expecting I would be expecting, and I was, right. A lot of the equities portfolios that I manage, we ended up buying here. We didn't quite time it here at the bottom, but right this point, early January is where we did a substantial buy of probably 50% of the allocated money for equities, right? So we pretty much bought here. And the valuation activity that followed really sort of proved my theory, right? So a lot of times when you're managing markets, when you're managing capital, you got to look at what's going on. You got to form a thesis. You make an investment, and then you're looking for clues that your thesis was correct, right? And so we bought here. Market ran strong. Tried to correct right here in late January, early February. Couldn't, right? Kept running. So we did another buy right about here. I think it was June. I think we timed that one pretty well. And then that was, I think, about 20%. And then we did another one right here in October. And so at this point, for my clients that are equity based, right, that they're equity weighed, we are probably 90% invested in terms of their allocation. I still have about 10% of capital that I will likely deploy when these markets pull in here. Oh, by the way, these two lines, the red line is a simple moving average, 50-day, right? So it's sort of where the price is. average price over the last 50 days, and then the black line is same thing, except the look back period is 200 days, right? So they're pretty good gauge, as you can tell. They contain the price, right? They contain the price here. They contain the price right there, right there. Everybody's looking at these things, and so there's all kinds of plans built around 50-day and a 200-day, right? So that's kind of the big picture, right? So a couple of things, right? The other part that I like to look at as we look for clues is you look at this sort of market corrected here, right? Or I'm gonna say this was a bear market. It wasn't just a correction. Then we ran up. Um, and then we sold off here, and then we ran up again. So now we're sort of trying to punch through the all-time highs right here at this 29.31 level, and then we try to sell off right here in August, and look what happens, right? The selling starts, and then the volume goes up, right? Meaning institutions were stepping in and buying shares, right? And that's the kind of thing that um, for me, for us, being small, right? I don't have to anticipate that all the way back here in 2018, early 2019, right? I can look at this and look at this behavior right here in August and start positioning, um, my clients' portfolios, right, or allocations, and be done, right? In a couple of days, be done, and set them up for this run that's going to come, right? So, so in terms of future expectations, what I'm looking for here is, in 2020 we have election that's coming up later in the year. I will be not looking to make any big, really buys or add-ons or allocation changes as we get closer to that. That's going to be kind of a big wild card. I think we're still sitting on a lot of our equity portfolios. I think I'm sitting still on about 10% of cash, and so I'm going to look for a pullback here, late January, early February, down to 50-day, and maybe even less than that, maybe down to like 3,000 level on the S&P, and we'll deploy the rest of that capital. So then a lot of my clients that are they have equity exposure will be fully invested in that allocation. All right, so that's S&P 500. Russell 2000 is another index very similar to S&P 500, except it represents the smaller companies, right? Smaller and medium level companies. It does not include the the large caps like the S&P 500. And the big difference here is a lot of these companies don't have global exposure, right? They're smaller, they're U.S. based, and so very similar kind of story, right? We had this sell-off, what I call bear market out in late 2018, 2019. It sort of bounced around in this range, and then now it's breaking out. We're starting to see a 50-day bounce. I'm gonna feel a lot better once we punch through the all-time high here at 1735. But it's looking pretty strong. EFA, this is international equities. Now they don't really track. I mean, they kind of sort of track U.S. a little bit. They're not really correlated. They're not very well correlated, I should say. But what this represents is Europe, Asia, and Far East. Right? These are the largest companies. The index is run by Morgan Stanley. And so what this represents is essentially the largest companies in Europe, Asia, and Far East. And you can kind of see a very similar story, right? 2018 was, a large correction. It looks like this market's been in a bear market all of 2018, right? Popped up and then sold off for the rest of the year. To me, again, that was the whole bear market, and now it's sort of on the mend. We're the 50-day, 200-day are containing the price action. So I'm going to expect to see. Um, I'm going to expect to see. I'll feel much better once we see a kind of a run up to the all-time highs here as well. But I'm expecting this to continue as well. So that's it for the equities, guys. Like I said, I will do another video for fixed income. But if you have any questions, please, send me an email, reach out to me, get in touch. If you'd like to work with us or work with me, please do the same. Thanks for tuning in.